Now, here's the part that should genuinely disturb you. The Iran war didn't save silver, not even close. Coordinated strikes on Feb 28th were supposed to be rocket fuel for metals. Instead, we saw a brief spike and then an absolute collapse. Analysts screamed safe haven demand, but silver still crashed, brutally. Note, this is not financial advice. What does it mean structurally when silver cannot hold a rally during a hot war? It exposes mechanics almost no one is talking about. The core mechanism, silver wasn't rising because of fear. It was a Fed policy bet. When that bet broke, the entire foundation vanished. The war was never the engine of this rally. It was always just the distraction. Today we unpack the real structural foundation. Ready to look underneath the surface? Subscribe for the full structural breakdown. Silver's 2024 to 2026 run was built on one thesis. The Fed was trapped. It wasn't about Iran or electronics deficits. Those were just noise. The signal was the Federal Reserve. Silver, at $121, was priced on a conditional promise, rates coming down and a weakening dollar. Every institutional position built above $80 assumed a meaningful pivot in 2026. But that assumption is now dead. The structural mechanic has broken, the signal has changed. Subscribe for more structural dissections, not financial advice. On March 18, 2026, the Federal Open Market Committee held rates at 3.5 to 3.75% and released a dot plot, that internal forecast mechanism that tells the market where policymakers expect rates to go, projecting just one rate cut for the entire remainder of the year. Not two, not three, one. Against a backdrop of persistent oil-driven inflation from the Strait of Hormuz situation, against a core PCE that refused to break below 3.1%, against a GDP revision that took fourth quarter 2025 growth down to 0.7%, the Fed effectively told every silver long in the market that their foundational thesis was structurally compromised. That is the mechanism. The Fed signaled that the rate environment would remain restrictive for longer than the market had priced. And silver, which had been engineered on leverage and conditional expectations, began the most violent repricing it has seen in years. Now let me take you 3 layers deeper, because the surface-level narrative, Fed is hawkish, silver goes down, is not the full story. What actually happened in these markets was far more structurally dangerous than a simple rate expectations adjustment. There are 3 discrete forces operating simultaneously, and each one of them deserves serious attention. The first structural force is the leverage unwind. This is the mechanism that turns a policy disappointment into a price collapse, and it is the most underappreciated dynamic in the current correction. When silver was trading above $100 an ounce, COMEX silver futures contracts had a notional value of $500,000 per contract, based on 5,000 ounces at $100. CME Group had already raised margin requirements in late January 2026 from 9% to 11%, and then again in February from 15% to 18% for heightened risk profiles. That means that to hold one COMEX silver futures contract at peak pricing, a speculative trader was required to post somewhere between $90,000 and $108,000 in margin capital. That is not small money for leveraged participants. And this is the mechanical trap that nobody talks about. When prices start falling, even modestly, participants who are leveraged 10 to 1 or 15 to 1 on these positions receive margin calls, not eventually, immediately, within hours. And to meet those margin calls, they have to sell, not because they want to, not because they've changed their view on silver's fundamentals, but because the mechanical rules of leveraged markets force liquidation regardless of conviction. And when forced sellers dominate volumes, which is exactly what happened during the March 18th through March 20th window, you get price action that bears absolutely no resemblance to fundamental value. Volume surged during the 6% single-day drop, confirming institutional selling rather than thin positioning. The SLV exchange-traded fund saw outflows exceeding $3.6 billion year-to-date by March 19th. That is not retail fear. That is institutional deleveraging at scale. The second and third order effect of this force is that the selling itself becomes the news. When silver drops 6% in one session, retail holders panic, algorithmic stop losses trigger, and the mechanical selling snowballs into something that looks like a directional market call but is actually just leverage physics. The market is not saying silver is worthless. The market is saying that too many people owned silver on borrowed money, and borrowed money has a forced exit clause. The second structural force is what I would call the dollar reconditioning trap, and this is where the Iran war narrative completely breaks down when you examine it structurally. Silver is denominated in US dollars. Every move in the dollar index directly impacts silver's price in real purchasing power terms. The US dollar index had climbed to a 3.5-month high of 100.35 by March 12, 2026, before the full Fed shock even landed. Now think about the mechanics of that. Iran conflict begins. oil prices spike. Oil price spikes feed directly into U.S. inflation data, particularly energy components of core PCE. Elevated inflation data forces the Federal Reserve to maintain its hawkish stance. A hawkish Fed stance strengthens the dollar because higher real yields attract capital flows into dollar-denominated assets. A stronger dollar makes silver mechanically more expensive for every buyer in the world who does not transact in U.S. dollars. Indian buyers, Chinese buyers, European buyers, their purchasing power for silver just decreased in direct proportion to the dollar's move. So the Iran war created a causal chain that, rather than driving safe haven flows into silver, actually tightened monetary conditions, strengthened the dollar, and structurally undermined the core premise of the silver rally. This is the brutal irony that the mainstream headline writers completely missed. The geopolitical shock that was supposed to be bullish for silver triggered a sequence of second-order effects that were mechanically bearish. The incentive structure of monetary policy meant that the very event people expected to save the price actually accelerated the conditions that were destroying it. That is not an accident. That is how interconnected, dollar-centric global markets actually function. The third structural force is what I call industrial demand destruction at peak pricing. This is the least discussed mechanism in current silver analysis, and it is going to matter enormously over the next 2 to 3 quarters. Silver's bull case has always rested on two simultaneous pillars: monetary demand and industrial demand. The industrial demand story is real and structural. Solar panel manufacturing, electric vehicle components, advanced electronics, and emerging applications in medical technology have created genuine multi-year supply deficits. The Silver Institute's data going into 2026 confirmed a 6th consecutive year of structural deficit. That is not manufactured bullish propaganda. That is a real supply-demand imbalance. But here's the mechanism that breaks when prices go from $40 to $120. At $40 an ounce, silver is economically viable for every industrial application in existence. At $120 an ounce, solar panel manufacturers are running cost of production models that make certain installations economically marginal. At $120, electronics manufacturers are accelerating research into silver replacement compounds. At $120, procurement managers in every industrial sector that uses silver are beginning to do something that has enormous second-order consequences. They are reducing forward buying. They are running down existing inventory before committing to new purchases at peak prices. And that deferred buying creates a phantom demand hole. The price was pricing in industrial consumption that was actually being rationed by the price itself. When institutional models start incorporating demand destruction signals, reduced procurement commitments, manufacturing margin compression, substitution acceleration, they revise silver's demand forecasts downward. And downward demand revisions at peak leverage positions amplify exactly the kind of forced selling cascade we described in the first structural force. These three mechanisms, leveraged deleveraging, dollar reconditioning, and industrial demand destruction, are not independent. They are reinforcing. The dollar strengthens, which pressures prices. Pressure on prices triggers margin calls. Margin calls force liquidation. Liquidation drives prices lower. Lower prices reveal demand destruction that was hidden when procurement teams were willing to pay above $100. Revealed demand destruction confirms the downward revision in industrial projections. Revised projections trigger further institutional selling, and suddenly a 6% single-day drop that looks like a mystery is actually a perfectly logical outcome of three converging structural forces that were always going to collide. The question was never if, it was only when. And here is where this becomes genuinely important for understanding where we are right now in the causal chain. The mainstream narrative says silver crashed because the Fed surprised markets. That is surface-level analysis. The deeper structure reveals something far more significant. The Fed did not cause this crash. The Fed revealed the unsustainability of the structural conditions under which the rally was built. There is a profound difference between a crash caused by an external shock and a crash caused by the exposure of a structural misalignment. The first type can be reversed quickly once the shock fades. The second type requires a complete rebalancing of the underlying conditions before a durable new base can form. Policymakers right now face an impossible set of choices that must be understood structurally. The Federal Reserve cannot cut rates aggressively because oil prices, elevated by Strait of Hormuz supply risk, are feeding directly into inflation data. It cannot allow the dollar to weaken meaningfully because a weak dollar would compound the inflationary import channels. And it cannot tighten rates further because GDP growth was already running at 0.7% in the fourth quarter of 2025, and additional tightening risks a hard landing that would destroy industrial demand for silver far more violently than anything seen in this current correction. The Fed is boxed. That box is not a temporary condition. It is the structural reality of an economy that accumulated too much debt during the zero-rate era, attempted to normalize rates too late, and now faces a geopolitical environment that has permanently repriced energy costs. In that environment, rate cuts, the foundational premise of the silver bull case above $100, are structurally delayed. They are not canceled, but they are delayed, and markets do not wait patiently. Markets price the delay immediately and completely. The critical question for forward-looking analysis is this: where in the causal chain are we right now? Silver dropped from $121.60 at its peak to $66.93 on March 19, 2026. That is a 45% correction from peak. The 200-day moving average sits near $55. The historical support zone established by late 2025 highs is at $55. We are currently in a territory, call it the $65 to $75 range, where the market is actively repricing what the appropriate silver price is in a world where the Fed delivers only one rate cut in 2026, where the dollar remains firm, and where industrial demand deferred by peak pricing has not yet returned. That repricing process is not over. The leverage unwind, while substantially advanced, is not yet complete. SLV outflows confirm that institutional rebalancing is still in progress, and the dollar has not yet shown evidence of a meaningful structural reversal. For a new base to form, a real sustainable base, three things need to happen mechanically. Leveraged positioning needs to reach a washout extreme where forced sellers have been exhausted. The dollar needs to begin a structural reversal, which would require either a Fed pivot or evidence of genuine U.S. economic deterioration. And industrial buyers need to return to the market with conviction, which only happens once prices stabilize at a level that restores their procurement economics. None of those three conditions are currently met, which means that anyone treating this as a completed correction is making an assumption that the structural mechanics do not yet support. Stay with me because the final part of this analysis is the part that most people in this market are completely missing. Here is where we land structurally. Silver is not in a death spiral. The supply deficit is real. The industrial demand story, once prices normalize to a level that procurement teams can work with economically, will reassert itself with significant force. The monetary case, central bank diversification, dollar long-term structural decay, real asset preference in inflationary environments, has not disappeared. It has been delayed by the Fed's current constraints, but those constraints cannot hold indefinitely. An economy running at sub 1% GDP growth with persistent inflation is not a stable equilibrium. It is a structural pressure cooker. When the Fed eventually pivots, and it will eventually pivot because the alternative is a deflationary economic collapse that is politically and socially intolerable, the conditions for silver's next structural move will be in place. The causal chain that drove the first rally will not be identical to the one that drives the next. But the underlying forces, dollar weakness, real yield suppression, industrial deficit, monetary demand, remain structurally intact beneath the surface noise of this correction. The positioning principle that follows from all of this structural analysis is straightforward and bears no resemblance to what the headline commentary is offering. This is not a market to chase on the upside or panic on the downside. It is a market in a structural repricing process that needs time and mechanical conditions to complete. The washout of leveraged positioning is a process, not an event. It takes sessions and weeks to clear. The return of industrial buyers is a function of price levels, not headlines. And the Fed's eventual pivot will not be telegraphed in advance with enough warning for reactive positioning to be profitable. The most important structural insight from everything we have unpacked today is this: the Iran war couldn't save silver because the war was never the engine. Geopolitical risk premiums are temporary. Monetary architecture is permanent until it breaks, and what broke in this correction was not silver's fundamental story. What broke was the leveraged, overpositioned, conditional bet that the Fed was going to rescue the trade. When that rescue didn't come, the trade unwound, not because silver is worthless, but because the price had been built on a promise that the Fed just revoked. And here is the question I'll leave you with, because I think it is the most structurally important question in markets right now, and almost no one is asking it seriously. If silver cannot hold a rally during an active Middle East war with genuine energy supply disruption and genuine safe haven fear, what does that tell you about how deeply the Fed's hawkish hold has inverted the traditional relationship between geopolitical risk and precious metals pricing? Because if the answer to that question is what I think it is, then the monetary system itself is undergoing a structural transition that silver is merely the most visible symptom of. And the next time the Fed blinks, when it finally has no choice but to pivot, the repricing in silver will not be orderly, it will not be gradual, and it will not look anything like what the models are currently projecting.